Step 1, select the best mutual fund. Step 2, invest in them. That's it. Simple. Really? Is that how you choose mutual funds? Getting the maximum returns from a mutual fund isn't just a matter of choosing the best funds and investing in them. No. There are some handful tips and rules that you should be following. It isn't that easy. Definitely, for sure. If you just simply close your eyes and choose the best mutual funds and invest in them, I can guarantee you'll not be 100% successful. You may not be. You can be if you're lucky, but you cannot be certain. Absolutely not. It might backfire. To take it easy in investing, what people do is they choose the best top 5 or top 6 mutual funds or top 3 or 4 mutual funds, high performing mutual funds, and they just simply invest in them. They are high performing funds because they have performed well in the past. And the disclaimer in the mutual fund industry itself says investing in mutual funds are subject to market risk. Please read the offer documents carefully before investing. Please read the offer documents carefully before investing. Past performance does not guarantee future performance and future returns. These statements are so very clear in all investing products. These are very common statements and we overlook them, maybe because, the investing companies, they play a trick. They keep these statements where? On that simple star terms and condition. They do mention it, but you have to find it, probably. But haven't you heard of all these statements? And yet, in spite of us knowing that the past performance doesn't guarantee the future performance, we still filter out the best 3 or 4 mutual funds and invest in them. What stupidity is this? So, to be on the safer side, don't just run after the top performing mutual funds, but I'll give you the 5 simple steps which you can follow to be a good investor. At least you'll not be chasing high performing funds and maybe be at risk. But hey, before I begin, I need a favor from you. Can I ask? Please do hit the like button and subscribe this channel. This will help this video reach a lot of people. I know a lot of people does this. A lot of people make this mistake. Please help them. Number 1, the expense, the cost of running the mutual fund. Every mutual fund would have a cost. You can see that in the expense ratio. And we as an investor, it's our duty to select the one that has the least expense ratio, or at least low compared to the returns that the fund is giving. So if there are 2 funds, one is giving, both of them have the same strategy, both of them they fall under the same purview, and probably both of them have given the same returns in the past, and they have the same investing principle, they have the same alpha, beta, so everything is almost the same, the ranking is almost the same, but their expense ratios are different. It could be one would have an expense ratio of 1.1%, the other one, or maybe 0.8% and 0.9%. You would say it's just 0.1%. How much difference would it make? 0.1% doesn't look good upfront, but over a very long period of time, when you have a long investing history, when you have a long investing journey, after 10, 15, 20, 25 years, when you cumulatively account for this 0.1% difference, it would be in lakhs of rupees. So if you're choosing a fund where everything else is same, if you're choosing a fund that has got 0.1% more in expense ratio, you would probably be losing lakhs of rupees at the end of your investing journey. Lakhs of rupees. That doesn't sound nice at all. We should avoid this, shouldn't we? Number 2, the index funds. Yeah, the index funds have the lowest expense ratio. And probably this could be the reason why, if you're trying to choose, or maybe if you're trying to get good returns at a very low cost, these could be the best possible funds for you. Currently, after SEBI reclassified the mutual fund industry, investing in large cap funds doesn't make sense. Why? Because large cap funds, SEBI has restricted the large cap fund management to invest in the top 100 companies. And the majority of them could well be within the top 50. So instead of investing in an active large cap fund, if you invariably choose the Nifty 50 index, it would be cheaper. An actively managed large cap index fund would have an expense ratio of maybe 1%. But on the other hand, we can get the same kind of returns from an index fund, which is the Nifty 50 index fund, by paying very less. But it's just not the returns, or it's just not that the cost of an index fund is less. It doesn't stop here. The index funds, they minimize the manager's risk. Sometimes a poor management decision can be devastating for a fund's performance. These risks are minimized by an index fund. So suppose for an actively managed fund, a fund manager might choose a stock which he thinks would perform well, but it doesn't. It takes a negative turn and it spoils your portfolio. But for an index fund, it has to mimic the index. Number 3, the rupee cost averaging. This is such a wonderful thing. It's an investing strategy where you put small amounts at regular intervals. The market goes up, you put in the same amount of money. The market goes down, you put in the same amount of money. When the market is high, the asset value is high, you buy less. When the market is low, the asset value is low, you buy more with the same amount of money. You buy high, you buy lower quantity. You buy low, you buy bigger quantity. Lower quantity, bigger quantity. Lower quantity, bigger quantity. You average it out. That's such a sweet spot. And definitely, mutual fund does allow this. Mutual fund investing or SIP investing is a cost averaging strategy. It is established, it is formed in such a way that you can do it automatically. Just set it up and it is done. You don't have to bother doing it every month. And the biggest advantage of this, when you set up an automatic investing system, it reduces the investor's error in timing the market, in controlling his or her emotions, in maybe utilizing his or her money in other areas of his life. These things happen. Absolutely, it does happen. No matter how smart you are, if you think you can do it manually every month, I can guarantee you, it cannot be done. It just cannot be done. I haven't seen a person as disciplined as this. That you have manually invested your money every month, month on month, year on year, without stopping, without pausing, for the next 20, 25, 30 years consistently, without stopping, without pausing, without withdrawing. No, it doesn't happen. Unless you set it up in an automatic mode, this strategy would definitely disrupt in between at any point in your life. There will be situations where you will be in need of money and then you will miss out on these investings. Automating these investments keeps money flowing into your investments. That is more important. This is more important than choosing a high-performing fund, choosing the best mutual fund, choosing the best investing stock or best asset to invest in, calculating, doing this, doing that. You'll keep on doing everything for years, but you will not invest unless you have set it up as an automatic investment plan. And yes, SIP allows you to do it. That's why it is named as systematic investment plan, because it systematically invests your money into your investments. And once you automate this, bingo, it's absolutely the jackpot. Do it for sure. That is why they say mutual funds सही है. क्यों? क्योंकि SIP सही है. Number 4, aggressive investing. Now, it's quite commonly heard that to get more returns, we need to invest in riskier assets. This is true, but this is partially true. We need not take on huge amount of risks to get very, very good returns. Yeah, aggressive mutual funds, they do provide us with a handsome amount of returns with a tolerable amount of risk. You can choose amongst You can choose to invest in an aggressive mutual fund portfolio which categorizes themselves into large cap, mid cap, small cap, and invest in them. Yeah, the expense ratio would be a notch higher than the index funds. That's okay. But you can keep investing if you're satisfied with the returns. If the returns really, really beat every other benchmark, you could probably be okay with the expense ratios. So simply, if you can diversify your investments between these kind of asset classes in mutual funds, that could be it. But yeah, definitely keep a long-term perspective, at least for 10 years. Number 5, asset allocation. Yes, the horizon, the time frame that you have in the market plays a very, very important role. Not necessarily that you have to rely on an aggressive mutual fund portfolio for a very handsome return over a longer period of time. Not mandatory though. It's also not mandatory, it's also not essential that you should be selecting the right investments for the longer period of time. But what is essential is you should have the right asset allocation. Understandably, stock market does generally outperform the bond or the cash market over a very long period of time, maybe for a time which is more than 10 years. But if your investing journey is within a 10-year period, maybe 7 or 6 years horizon, it's wise to keep a part of your portfolio into bond or bond funds or into gold, just to be on the safer side. Because anything which is less than 10 years for me would be very tricky to be in the stock market. Beyond 10 years, yes, definitely. The market would definitely outperform the bond market. But it cannot be absolutely sure if it is less than 10 years. So the time horizon will tell you about your asset allocation. You cannot put everything into the market and say it's okay. No, it is not okay. You can put everything into the market and be okay if your horizon is more than 10 years, at least 15 years to be on the safer side. Anything less than that, I would recommend definitely to have something into the bond market, something into gold. Understand, these investment assets would not generate or give you the returns that the market can give you. Even for 6-7 years, probably the market can give you more returns than bond, or gold. But cannot be sure, absolutely. So to sum up all of these, the best mutual funds are those that combine your risk tolerance and the time horizon that you want to be in the market. The best mix of mutual fund portfolio are those which have the best asset allocation as per your risk appetite and the time horizon that you have in the market. So once you have identified your investment objective, make your money work for you. And probably the index funds would be the best place to park it because it works at a very, very cheap expense ratio. Hope that helps. See you again in the next video. Till then, SG signing off. Goodbye.